Hey, good evening, everyone. Marty Mazur here. September 3rd, 2020, in the evening. Wasn't going to do a video today. I think I already hit you with 2 blog posts, but pretty dramatic sell-off today. Just finally getting to my end of day exercises, and I thought, yeah, this is probably a day worth talking about, at least briefly, on the video. Over here you have just some metrics that not everything we track in credit markets and in equity markets. This is just the US. Mostly there's some NASDAQ data in here as well, but mostly the S&P. But stuff that's worth looking at every day just to kind of get a feel for the meaningfulness or otherwise of the day. Yesterday we had a big up day and it was actually meaningful, positively. I mean, the breadth was good, the volume was good. And it was a bullish day. Today, it's meaningful, and a bearish day, certainly from a volume standpoint, much more meaningful than yesterday was in terms of bullishness. Now, remember, when I talk about volume, I'm talking about passion, excitement. Lots of volume means lots of transactions going on, a lot of people coming in and buying and selling. So first, I'll just run through the credit market stuff. I'm going to try to keep this quick. So these are things we've looked at before. Currency basis swaps just has to do with liquidity and the ease of converting foreign currencies to dollars. I may, time permitting, pull up the dollar and the euro chart, or I may just talk about it. But regular readers of the blog should know that I think the dollar is key. In fact, that's what I titled our weekly message. Strong dollar is problematic in a big way. It has to do with, from just a fundamental standpoint or a basic standpoint, big multinational U.S. companies, which really comprise a real concentration in the major averages right now. Their stuff that they sell to their foreign customers gets more expensive when a dollar's stronger. And right now, this is not a time to have things more expensive to half or more of your customers. Also, it does a real number on the holders of dollar-denominated debt internationally, and that is very problematic potentially. So it doesn't bode well given and I'll just say it, I've explained it before on the blog, but the carry trade that really pervades global financial structure. And the stronger dollar is really, really problematic. So it feeds into the bubble thesis that we presented a year ago, the thing that would make this the worst recession or the next recession whenever it happens since the Great Depression. Of course, COVID just really drops a bomb on any narrative. So anyway, so the credit markets, this color isn't bad. It is a little worse today versus yesterday. But companies that invest in business development companies and that sort of thing, being down 28%. Leveraged loan index isn't bad, thanks to the Fed. Private equity ETF is coming off a bit, down 13% year to date. High yield growth ETF only down 3.66% year to date. That's remarkable given the risk in the high yield market, but it's because the Fed is jumping in and buying corporate bonds. The muni treasury spread has been concerning me. That's actually been going up in a real upward trend fashion. So that means the credit markets are actually pricing in heightened risk of default in the municipal bond market. We can talk about COVID and local taxes and lack thereof and so on, so it makes some sense. The high yield spread is backing up a bit. This one's a day late, so I think tomorrow it'll be higher, but it's enough to color it red. BA spread, 3.42%, 61% wider than when the market peaked. Above treasuries of similar duration. The BB, triple B spread's a little higher quality, 1.77%. That's been moving higher. The credit default swap, the investment grade index at 66, that's been on the rise of late as well. Our own financial stress index sits smack dab at 0 as of the last calculation. So you'd like that to be green. That would say a real good, easy credit environment. Things have worsened a bit of late. But to the stock market. So again, volume. Today's volume, 24% above yesterday's, 33% above the 5-day average, 39% above the 10-day, and 38% above the 20-day average. That is a real spike in volume. and it happened when the S&P was down 3.5%. Tech, 44% above the 20-day average, almost a 6% drubbing in tech. Industrials was the lowest, 26% above the average, down almost 3% on the day. That is just really, ugly stuff, bear market stuff. New York Stock Exchange up versus down volume, 1347 to 3619. S&P advanced decline, 53 up, 450 down. NASDAQ, what is that, 4 or 5 to 1, up versus down versus up. 4-week high-low, can't be right. I've got to check. There may have been a delay there. 23% of the SPX hitting new 4-week highs. Well, 23% of 503, or let's just say 23% of 500 would be 115. Well, we only had 53 stocks go up, so that's, I'm going to have to put an X through that one for now. 52-week highs, we did get 3. That could happen, right? That would be 15, actually 17 in one 52-week low, so I colored that green. The NASDAQ, 4-week high-low, 9% versus 21, 176 new highs, almost 600 new lows. 52-week high-low, 27 versus 35. Still 61% of the S&P 500 trading above their respective 200-day moving averages. NASDAQ, when we're below 50, it's red. When we're above 60, it's green. Between 50 and 60 is yellow. MACD, I'm going to show you a little bit of that in a second. Buy-sell signal, 16% of the S&P is on a sell signal, or I'm sorry, a buy, 27 on a sell, 16 and 20 for the NASDAQ. So really it's up here though, folks. This is bad volume, bad breadth on a big down day. Does it mean that this is the beginning of something more ominous to the downside? No. Have I been pointing to excess risk of that occurring relatively soon? Sure. And does that mean we keep a very diversified portfolio, pretty good chunk in cash, and hedged with options while that risk is there, regardless of whether or not the market continues to melt into new all-time high territory? Yes, we do. Am I predicting that the market falls apart? No, that's what I keep telling people is, no, I'm not making a prediction. I'm assessing the risk, or we are here at PWA. And when the risk is this high of something really ominous again on the downside, well, we need to protect against that. Now, we're going to catch some downside, no doubt. Today, our core portfolio was down, I want to say about 1.5%. All of our positions except for tech actually outperformed the S&P 500, of course, outperformed the NASDAQ hugely. And our put option was up about 33%, but we're still quite a ways from the money. So 33% on something that really isn't huge yet in portfolios certainly did mitigate a chunk of the decline, no doubt about it. As the market moves further down between now and the end of the year, if indeed it does, those hedges become much more meaningful as we go. So yeah, today is not a day to say, well, no big deal. Volume was all over the place, breadth, blah, 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 or volume wasn't strong. Not the case. This looks, this is a bear market day. We'll see how it shakes out. We got continuation in the futures market as we speak. I'm sure the Asian markets are getting pummeled right now. I haven't looked yet. Dollar's kind of hanging in there. Dollar's problematic if it rises. I've told you a lot recently about the fact that it's way oversold. The euro is way overbought. The euro is the biggest component opposite the dollar in that index. The euro at such a high level is problematic for Eurozone securities, equities in particular, and Eurozone exports and everything that goes with a higher currency. And the ECB meets a week from today, and I expect them to talk down the euro. If they talk down the euro, that's essentially talking up the dollar. And a higher dollar in this environment, as I've expressed for weeks and weeks and weeks now, is not what the powers that be are looking for. And that could have something to do, yesterday's big spike in the dollar could very well have something to do with today when there really wasn't some big obvious catalyst for today's sell-off. So there you have just the internals, just down and dirty, that we look at each day. Let me pull over something that'll look very familiar to you, longtime clients and viewers. So the S&P 500, roughly a 2-year chart. Upward wedges. I've shown you this a million times. We're still in an upward wedge pattern here. Came down today and closed right on that uptrend line. Right, literally on it is where we closed. Dipped a little below it, closed on it. So we go we go pounding through there, technicians are going to see that as a breakout below. And if it happens for a few days and we get some space there, then you could see something precipitous that would take us down lower. I showed you my own kind of homegrown little volume indicator here. The daily volume, the 20 period moving average, or the 10 period moving average. And then what happens is when the market's rallying and volume is dying, okay, that's the opposite of what I talked about a minute ago, right? That is lack of conviction. Well, lack of conviction in a strong market that's making its way to new all-time highs does not say much about the sustainability of that. So when I start drawing these circles, you can see it's happened at some times when the market has dipped a bit or become problematic and so on. So the worst case scenario is where you go down and touch, market begins to fall apart, and you get a big spike. So that says now the volume and the passion is on the bearish side of the trade. That's what we got with that big sell-off there. And as I just showed you, we got quite the spike in here today. So that's something for sure to keep our eye on. Looking at momentum, the moving average convergence, divergence, that sell signal and buy signal that I talked about, that's not really something that I pay a lot of attention to. Bloomberg offers that up on the breadth page. So I on a short-term basis, sure, it does talk about breadth and how many of the stocks or the members of the index actually have the white line above the red. Okay, so that's on a buy signal. The white line dropping below the red is a sell signal from a momentum standpoint. Now, longer term, what I look for are these, either confirmations or divergences, and we've had a long bearish divergence in the MACD. That was just telling us that this rally may not be long for this world. And then the RSI, Relative Strength Index, it's called, and kind of an overbought, oversold indicator. As you can see, we broke through that bearish divergence, so that was bullish, but we got to such a hugely above 70 overbought condition, and that's extreme, and technicians pay a lot of attention to that. So you're going to have to remedy that either by just moving sideways for a while or doing what happened today, coming down. Notice the overboughtness right before the market rolled over there. So folks, again, we're just scratching the surface here in this video, and I'm going to close right now. The macro, and tomorrow we're going to update our macro index, so I'll have that update for you probably tomorrow like I usually do on Fridays, and just kind of give you my thoughts on macro conditions. That really is ultimately what's going to guide us in terms of our asset allocation. But the technicals have been looking sketchy. The short interest is kind of dried up, so you don't have big upside support. Getting into the weeds a bit, I've done this a little on the blog, there's something called gamma exposure, and it has to do with folks who sell options to other folks. If they're selling a lot of call options on Tesla and Apple, for example, well, some of that big upside move that we've seen, this big parabolic move for sure, has actually been, believe it or not, options sellers not betting on a big upswing, but having to hedge their exposure by buying the stocks to hedge that call exposure that they have. If that flips, and that's a term that's used, and sentiment goes, there's a point where suddenly they're having to hedge all of the put options they sell. And how do you hedge put exposure if you're a seller? You short the security. What happens when you short it? You sell it into a falling market. It exacerbates the downside. So folks, there are deep in the weeds structural things that have really been looking risky here for this market to continue to hold up. Hence, again, I'm not going to make predictions. I'm just going to assess risk here for you on the blog. But if you can tell, and clients, as we've been talking about in our review conversations, yeah, it's the stuff that's been kind of supporting the market up to this point into these new all-time highs. A lot of that is evaporating. Does that mean we don't get some announcement from the White House tomorrow that gets people rushing back in? Sure, it doesn't mean that. Of course, we could absolutely get that. As long as conditions, general conditions, let's just say, are what they are, we are not going to go rushing in and investing like we did from the bottom of the last one all the way up to August of 2019. Conditions told us to do that then. They tell us to do something quite a bit different right here. I'll leave it there. Thank you, folks, as always, for watching and listening. Much more to come. Bye-bye.